It was taking a rest. You know, it looks like if you look back at the last 5 or 7 days, it looks like the market has been in a pause of some sort, up about 0.5% in 5 or 6 days. So I think obviously everyone can see the charts and say on a very short-term basis, this market looks a bit stretched, probably needs to settle out a little bit, even pull back to some degree. But really, it's not looking like it's much selling. It's just kind of a little bit of fatigue in there. Also, the reaction to Powell's testimony today was really a non-reaction, which I guess really tells you that the market has fully absorbed the Fed patience message that he was delivering.
Barry, can the Fed get any more supportive for equity markets and without the fundamentals getting a lot worse, which I guess wouldn't be something we'd want to see?
No, I don't think so. I think that Fed global synchronized pause trade is pretty complete in terms of its impact on the equity market. From this point, it'll be more about what happens with the fundamentals. I suspect the next big trade related to the Fed will actually be the bond market starting to sell off. And if you look at what's happened so far this year, you've really pressed the 10-year non-inflationary or real rate component down decidedly, some 27 basis points or so. This is what the non-crisis period of QE from 2010 to 13 did. It took that level, that rate from 1% to minus 1%. Yeah, okay, the Fed is on hold and they may stop the balance sheet purchases, but they're not about to restart asset purchases. So I think you have a pretty good chance as the data starts to stabilize that we get a decent sell-off in the bond market back above 3% on 10s at least.
Steepening curve with it?
Probably, yes.
Just to dig into that a little bit more, if you have signs of weakening growth globally, and I know the Fed chair talked about that in front of Congress today, and that has really been anchoring interest rates abroad, how much can the U.S. bond market sell off?
Well, the real question will be what happens to global trade over the next couple of months, right? Because that was clearly the catalyst for the stock markets in Europe and in Asia selling off back in the summer. Right? The data finally rolled by November, December, and January. It probably doesn't get much worse than it did. I mean, Chinese imports from the U.S. fell 40% year on year in the month of January. You'd have to think you get some degree of stabilization. There was front loading of orders. There was maybe some boycotting of U.S. products, but you'd think that that would start to stabilize, and so growth would look a little bit better from that perspective. So I don't think that things are on the verge of collapsing globally. I think that story is largely behind us.
Mike, what do you make of the fact that the Russell was such a big underperformer today?
Yeah, I think it's the stuff that has led off the bottom. It looks like it's coming in for a little bit of a retrenchment. So the Russell is part of the risk on trade. I mean, semiconductors were down today more than the overall market. If you look at Nvidia through the day, it did bleed lower. So I think it's one of those kind of first up is the first to kind of reset a little bit lower. I don't know that it was necessarily a global macro impetus to that.
And in terms of the level, Mike, that we've been looking at, the 2,800 level proving to be more of a resistance to the upside as opposed to a breakout above it.
At least for now, yes. We're kind of stalling out right here. Again, it's one of those things where you have to ask yourself, is the market going to be just exactly that cute for a fourth time since October to stop right here and then pull back sharply? I mean, maybe. It's very widely watched. It's also at a time when you had a 19% run off a 19% decline. So there's some kind of asymmetry that got us back here.
Let's talk about stock specifics. Home Depot, one of the worst outperformers today after missing on earnings estimates this morning. The company forecasting poor 2019 earnings, citing slowing U.S. housing momentum. It also announced a $15 billion buyback. It's down about 1% by the close today. Coming with some poor housing data as well, Mike. What's this telling us about the consumer? There's been a lot of differentiation across various consumer stocks.
There definitely has, and in fact, broadly, retail was okay today. It was sort of a Home Depot story. Obviously, a pretty decent undershoot to the guidance for EPS this year versus what the street was looking for. Also, one of the more expensive big retailers. It kind of has that status as being one of the quality names. I mean, it's very steady. 18 times forward earnings, though, is obviously more expensive than most retailers are these days. So that's why I feel like it's in a different spot versus ones that really need a strong consumer to kind of flush in there. What's interesting too is when new car sales decline and the numbers are really bad, the auto parts stocks do really well because people say, well, you're going to have to pay more on your existing car. It's a little less so with Home Depot because they do rely on housing turnover more than others.
Yeah, and Barry, what is the read-through in terms of housing, where we have seen some soft data, and in terms of the consumer, because on the flip side, we did get that strong rebound in consumer confidence today as well?
Actually, I would argue that some of the leading indicators of housing have turned up, right? So that home builder surveys better, the home builder stocks are rallying. We've had a pretty good sized drop in mortgage rates. So it's funny, you know, when you think about why the Fed went on hold, this idea that consumer price inflation is not responding to slack and hasn't done for 2 decades. The one area where it is responding to slack is in the housing-related components of CPI. And as things went up through the course of last year, you did have this slowdown in housing, but to me, it looks like there's a bit of a re-acceleration underway. And so maybe, you know, Home Depot is a little bit part of that. If you get a pickup in construction because rates have come in and the Fed is now on hold, you could get a pickup in that sector.
And permits were strong too within the new homes data.
Right.
Usually is a leading indicator.
Barry, stepping away from the home stocks and talking about earnings season more generally, I guess people have framed it as suggesting, fine, that quarter was okay, but the guidance is looking worse for the year ahead. Do you buy into that negativity for the year ahead?
I really don't. I followed, Mike and I were talking about this a little bit earlier, I followed earnings revisions for a long time, going back to my days as Barclays equity strategist. Equity analysts follow prices. I mean, earnings get cut when prices go down, earnings go up when prices go up.
Stock prices.
Stock prices, excuse me. And thank you for helping with that. I think when you think about the last earnings recession we had that was not associated with an actual recession in 15 and 16, we had a 75% decline in oil prices. We had a 25% increase in the trade-weighted dollar. We had China's heavy industry go into a hard landing that caused commodity prices to crash. None of these things are true. The revenue numbers are much better now than they were then. I think all this talk about negative earnings growth, even for a quarter, is highly unlikely. And I do hear this argument periodically that, well, we've reached peak margins. And if I had a nickel for every time I've heard that through this entire business cycle, I don't believe that that's true. And so I think we'll escape with a reasonable number in the first quarter, and we'll reaccelerate to low double digits by mid-year and into the second half, in my view.